Hello and welcome to GoodGood Investing. I'm Rachel Grunn.
And I'm Andrea Cwik.
So GoodGood Investing is all about providing education and investment opportunities to successful entrepreneurs and very busy professionals on their journey to financial freedom.
Absolutely. We help and educate those entrepreneurs and busy professionals with knowledge to empower them to build their real estate commercial portfolio.
And take agency over their financial future. That's
Yes,
a huge
absolutely.
aspect of our business, as we want you guys to feel confident and excited about where you are headed financially, and we all hope for early retirement,
Yes,
which
please.
I'm excited about. Please, but not the podcast. We love the podcast. We'll do this till we're 85. But we're talking about retiring from the other type of work that we really don't want to do.
Yeah.
So today, we're talking about kind of doom and gloom a little bit, right? Like what could go wrong. And we're not scared of talking about what could go wrong because it's not all sunshines and rainbows all the time. There's risk in any investment that you make, and multifamily is not excluded from that. We love multifamily and other types of commercial investing because it mitigates a lot of that risk. But, I mean,
nothing is guaranteed.
Unless you're in a 2% savings account.
Right.
That's guaranteed. Yeah, that's guaranteed. But that's not enough for us. So, right now we're kind of heading into a very weird economic landscape with interest rates, and obviously we've seen a dip and some people are screaming recession. So I guess we could talk about what could possibly go wrong in a multifamily investment. Like, let's just do it. Let's just say everything.
Yeah. I think one of the things that has gone wrong in the past is when we purchase a multifamily asset, we do our due diligence, right? But there are some things that maybe we have gotten used to, like in our underwriting, let's say, which just means when we're looking at the asset, we're looking at all the financials, we have an interest rate that we got from like a mortgage, right? For the asset, we borrow against it, but then the interest rates are not locked like a 30-year loan is, like on a typical house. So sometimes we might go into different loan products for our multifamily. So one of them is bridge. So there is risk in bridge loans because if the interest rate goes up, then the bridge loan percentage interest rate could go up. So then we typically get insurance for that called rate cap rate. I always get those two mixed up. Rate cap, right? So it is an insurance that our interest rate won't go above a certain amount. But in the in-between, if it goes higher and it just keeps going higher in a small amount of time that you haven't accounted for, because maybe you didn't think that the interest rate would escalate that quickly, you're having to make up for that increased payment, that increased loan amount. That is a lot to digest there.
No, but I mean, it makes sense. It's a variable rate mortgage. It's short-term debt, so no one expects to have bridge debt for the entirety of the loan. Generally, it's just for the rehab period, and then refinance out of that bridge loan into a traditional mortgage. So instead of paying out dividends, this is like what the implication would be for the investor at that point. So instead of paying out dividends, right, because we say we aim for quarterly distributions, instead of paying those out, we might be withholding cash in order to service that loan until we do a refinance.
Yeah, and that's because our expenses at that point have increased. And the whole idea about a multifamily asset is to get cash flow, but out of the net operating income. But if our expenses go up, that means that our income might have gone down. And so we really want to be conservative, and we don't know how long our expenses are going to be up, right? So we might hold on to the cash flow that we predetermined or that we thought we would distribute to our investors, just in case we have to hold that, onto it for a longer period of time.
Yes. So again, these are like 5 to 6 year investments, and a lot of people, if there's bridge debt, it's usually in the beginning. I mean, no one would have bridge debt, I feel like, in the middle or the end of a hold. It's usually in the beginning. So a lot of people are quick to scream the sky is falling. However, it is a 5 or 6 year hold, and though in the beginning it might be a tighter squeeze than expected, there's so much time and room to bounce back from that, and you can definitely, like Andrea said, mitigate other expenses, right, in order to make up for that difference. So that is something that could definitely go wrong. Other things that could go wrong, I mean, are of course bad underwriting. Like, we've seen deals. One of our partners that we work with closely, he told us about a time where the property taxes were not accounted for correctly in the underwriting. And it went from like 150% return to like a negative 28% return when you just adjusted for the property taxes that were left out of the underwriting. So it's really important, in order to mitigate your risk, that you're choosing sponsors that know what they're doing, have seen multiple economic cycles, and know how to underwrite a deal properly.
Yeah. Another thing that could go wrong is remodeling. You could, we could have like really had a plan on when the contractor was going to turn over a unit, what they were going to do. I know in one of our assets, we were waiting for new appliances. So all the old appliances had been taken out to prepare for the new ones. Well, it got stuck on a boat for months. And so now we have unused units because there was no appliances in there. So just things that are out of, the ordinary could potentially happen. Not something that happens all the time, right? But for that particular asset, that's what happened.
Yeah. And then, of course, there's things outside of our control, acts of God, right? And of course we have insurance, comprehensive, because the lender literally requires that we have like the highest level of insurance available, because technically speaking, the lender is the majority owner. So we have comprehensive insurance, but there's still deductibles to be paid if there is a natural disaster. And if the natural disaster is catastrophic enough that it misplaces tenants, that's loss of income. Now, we also have insurance to make up that loss of income, but not entirely. So, of course, that's always a risk as well, is how long is it going to take to make a place livable again, to get the payout from the insurance company, to start construction, to get the property back to operating condition. That's why you're seeing in a lot of places like Louisiana, for example, insurance rates are absolutely through the stratosphere. Like, I'm talking thousands of dollars per door, per unit. That's insane. And then there's other parts of the country, and I think especially now, and if you're a homeowner or you have a car, I'm sure it's no secret that insurance is rising everywhere. Yeah. So we've been prioritizing markets that have lower insurance because there's just not as many natural disasters, like the desert, for example. So we've just closed on a property in Arizona. Super, super, super cheap insurance rates.
Yeah, not a lot of stuff can go wrong in Arizona.
No, not a lot of stuff can go wrong in Arizona. That is correct.
Another risk could be that a lot of tenants' leases are up at the same time. So that gives us a low occupancy rate. So we have to just work harder on the marketing side to get new tenants in. And that could show a blip in our financials and our net operating income. So that is a risk, right? That you'll have some months where it could be that you're lower on your income than other months.
Multifamily is very operational heavy. You have to have, it's not just a good sponsor that can find a good deal, right? Mm-hmm. It's also a good team that can run a good business. Yeah. Because so much of your return is dependent on after closing. Yeah. The property management company, yes, but also the asset manager that's managing that property management company. So, I mean, you have to know the whole team, not just the acquisition side, but also the management side. Who's running it, and that's going to be a huge factor in mitigating your risk as well.
Yeah, I think one of the most important key players on the team, and there's many, but one of them is just that front office team that is helping new tenants come in, servicing them, answering their questions, helping with the application process. That's key. And we have had a situation where a person that was in the office wasn't as good as we thought. And so that also gave us some occupancy issues. But, we're always checking. There's something called secret shopping that we'll do as a team that we've implemented just to make sure that our front office staff are helping our tenants. So we definitely have faced some of these risks, have gone through some of these hard times. But like Rachel said, it's a long-term hold, like a longer-term hold. And so we always learn and try to address these issues as fast as possible. But at the end of the day, real estate, even with the market being the way it is, has shown to be a more stable investment.
Yes, 100%. I mean, if you just look historically, even during down times, it always bounced back in a matter of just a couple of years. We're not talking decades or anything. So I think, I think the biggest, if you choose a strong team and a strong team who has a great management arm as well, the biggest concern is going to be unreliable distributions. That's it, in my opinion, because if it's a strong management team, they can bounce back for nearly anything. However, your cash flow might be impacted, right? Not your overall return, but your cash flow in the meantime. That's not a guarantee. We strive for quarterly distributions. It is not a guarantee. I mean, nothing's a guarantee, really. So I think that would be something to consider is during these difficult economic times, we might be seeing some cash flow dry up.
Yeah, I mean, and yeah, I have some that aren't paying any. There's some that are paying a little bit. It just really depends. So you might not see the cash flow right now in year one. I don't know. Will it last for the whole 5 years? I don't think so. It's hard to say. Like Rachel said, I mean, nothing is guaranteed. We definitely strive for like the 7 to 8% cash flow. It's almost becoming unreal now because all I see these days in terms of new assets, even from competitors, like I'm seeing them at like a 5% cash flow and like a 80 to 90% return. So we're just being a lot more conservative, but do I think that there's cash flow in the deals within the 5-year hold period? Yeah, I think that we will see cash flow. Do I think that the asset is going to appreciate at 2x or whatever projections were? I think it's still possible. I think it's still possible that it turns around completely and we see even higher returns. Could we see lower returns? Sure, it's a possibility, but still truly believe that real estate is a great way to build wealth compared to a lot of the other assets that you could invest in. So
yeah, it's kind of like when the captain turns on the seatbelt sign when they expect turbulence ahead, even though that may not hit. That's kind of what operators are doing with turning off cash flow distributions.
Yeah.
They just want to keep their cash reserves heavy in case there is anything that happens. It doesn't mean something has already happened. It just means they're being conservative. Operators all across the country did the exact same thing at the beginning of COVID, and then properties were selling for 300% return 8 months later. Yeah. I don't think that's going to happen again, but that's just to say it's not all doom and gloom just because maybe your distributions aren't paying out when you thought that they would be. But it is important to know the risk involved so that you can make an educated decision when deciding to invest.
Mm-hmm, exactly.
Anything to add, Andrea?
No, I loved your illustration about the turbulence in the pilot. I love that.
Yeah, well, you can have it. It's yours. Guys, thank you so much for joining us for another week of GoodGood Investing. We have kind of a guest-heavy month ahead, so we're really excited to introduce some exciting guests for you guys that hopefully bring a lot of value and make you think differently about your future financial career or otherwise, because that's all that we want to do at GoodGood Investing is blow your mind and change your life. That's it.
Yeah.
Just those two little things. Well, until next week, don't invest good.
Invest twice as good.
Bye.